So let's have a look at this question then, and we'll do this. I think it's better to explain this by doing the actual numbers. So the first thing I want us to look at is the historic cost. If we're using the historic cost model, then what is the historic cost? Well, historic cost is cost minus accumulated depreciation. So in this case, the cost is 280,000. We bought it a year ago. Depreciation is 25%. So 25% of 280,000 is 70,000. And so therefore the net book value using historic cost would be 210,000. So that's historic cost. What about fair value then? Okay, first of all, what is fair value? Well, fair value is the price that would be received if you sold an asset or if you paid a liability in a normal transaction between people at an arm's length transaction. Okay, so what would it actually sell for? What would be its fair value now? And the fair value would be the 88,000, because this residual value, maybe I should put, that's the residual value now. So its fair value is 88,000. Ignore the cost of advertising. Okay, let's go on to current cost accounting. If we was using current cost accounting. First of all, to remind ourselves what current cost accounting is, it's the amount that you'd have to pay if the same or an equivalent asset was acquired currently. Alright, so the same or the equivalent, so that's the replacement cost, 360,000. But it says the same or the equivalent. This one is 20% more efficient. So this one is working at 120% compared to our 100%. So therefore, all you've got to do is divide that by the 120 and times it by the 100 to get to how efficient we are now. So that would be 300,000, but that would still be for a brand new one. Okay, I want to know the equivalent. So that's dealt with the efficiency. So deal with the efficiency first, and then deal with the age second. So we now have to depreciate that 300,000. So that 300,000 then needs some depreciation on it, and the depreciation 25%. So 25% depreciation would be 75,000. So that would bring you down to 225,000. That's the current cost. Now let's have a look at net realizable value. Okay, net realizable value, what we could sell it for, if you remember, was 88,000. And the difference between that and the fair value now is that it's the less cost to complete the sale, which is the 500 cost of advertising there. So it would be 87,500. All right, finally, the present value of future cash flows. The present value of future cash flows. So take all your future cash flows, which would be 40,000 a year. As it's the same amount here, then you can use an annuity. Now, the examiner would probably give you the annuity in the exam. So the annuity for 6% for 5 years, I will give you it as being 4.212. So you just take the 40,000 and you times it by 4.212, and that comes to 168,480. Whoops. So 480. So what you've got to go do then now is go and do a few more questions on this.